Hello, everybody, and welcome to our April webinar. I'm Betsy Kenyon. I am the marketing coordinator here at Elevate Wealth Advisory. If you're new to us, our firm was founded 42 years ago by Chuck Vickery as Vickery Financial Services, and Chuck founded the firm with the goal of helping people make smart decisions with their money. Here we are 42 years later, and we're still doing that same thing, but we've now grown to a team of 10 people led by President and CEO Deanne Rosso. And we are still working hard to help people make smart decisions with their money, but now we are Elevate Wealth Advisory. Today, I'm really excited to introduce you once again to one of our most seasoned advisors, Clarke Holt, who celebrated his 20th year with us last year. And he is going to be here today discussing behavioral finance, or as we are calling it today, the psychology of wealth. Clarke lives here in Athens with his two beautiful daughters, and he's been with our firm, as I said, since 2003. Welcome, Clarke.
Hey, thanks. Thanks, Betsy.
I wanted to ask you, how did you become interested in the subject of behavioral finance?
It it happened it just kind of out of the blue. I think along my career path, as I realized that it wasn't just about picking the very best investments or the best asset allocation for clients. It was more important to provide behavioral coaching, and so for me, that just really interests me, and it gives me a lot of satisfaction to help people stay the course and to sometimes help people not make mistakes along the way. And there's plenty of temptation to do that through all phases. And so it's just a passion for me, and I enjoy it. It's a big focus, and it actually happens to be one of the most important things that we as advisors offer clients and bring to the table.
I love that. I know it's an interesting term, and when you say behavioral finance, it's not really obvious what it means or how it impacts the average investor. So I'm excited to hear the presentation today. Throughout today's presentation, if you guys have any questions for Clarke, put them in the chat box or the Q&A box, and we'll make sure that we get to your question. If we run out of time, we'll go ahead and get in touch with you by email. All right, Clarke, whenever you're ready, I'll let you take it away.
Okay, thanks. Just going to share my screen real quick. So everybody should be able to see this
Yep, perfect.
intro slide. And so we're calling this the psychology of wealth and how your behavior can impact your financial future, not just how much money you have in your accounts and or your portfolio, but it's all about the big picture. Can you reach your goals? Can you achieve those things you've set out to achieve? And so, again, it's a passion of mine to talk about this. And I actually was talking with my colleague Deanne Rosso last week, and we were discussing the phases along the way of uh, your financial life, whether that's the wealth building phase, the transition phase, all the way to the distribution phase. And the what I'm about to talk about can impact you at any point on that journey. And so it's important to continue to have good behavior along the way, not just early on, but even in the end. And so let's get started real quick with a quote from Nick Murray, who's a noted author. He was a financial advisor for many, many years, and now he travels the country and speaks to people in our industry, financial advisors. He's written a lot of books. And so one of my favorite quotes from him is the dominant determinant of long-term real life returns is not investment performance, but investor behavior. And so, obviously investment strategies, investment products, market conditions, building diversified portfolios, things like that, they're important, but it's really the investor behavior that's the X factor in determining having that long-term successful outcome. Obviously our emotions, cognitive biases, the decisions we make can really impact our performance and our experience. And when people follow their natural instincts, we tend to apply really faulty reasoning to investing. And just understanding and managing investor behavior is crucial for achieving long-term success. And I mentioned earlier, I was early in my career, I was really into numbers and investments in particular, like track records and things like that. And those are important things to focus on, numbers and data. But truthfully, it's the behavior, it's the human behavior that provides us with most of our success over time. And just understanding the psychology of an investor can help us make better choices for long-term success. And so we'll cover some psychological factors that influence investor behavior, and then look at consequences, strategies for developing a more positive, disciplined mindset so that we can, again, have that long-term investment success. So humans are not wired for disciplined investing, and it's just a fact. We're not. And there are so many different things we can have mental errors about that can cause us to make knee-jerk reactions that have consequences, whether it's I'm in a certain industry, I work in this industry, I know this sector, I want to have, maybe more money than I should in this particular investment. Or maybe it's we've invested in such a way and it's declined, but we're afraid to sell, obviously, because we don't want to take that loss. And so looking at trends, stocks can go up, stocks can go down. It's a very challenging game. And it's not a game. But it's one of those things we have to stay grounded and make smart decisions and have the discipline to navigate through different market cycles, different economic cycles, and again, to have that long-term positive experience. So looking at cognitive biases. So we've got a couple I'm highlighting real quick. Overconfidence, which is just really overestimating our abilities to pick winners or really good investments. And that happens a lot. And no matter who you are, where you are on that retirement transition phase, we sometimes believe we have the ability to pick certain investments or really good investments, and hoping for that, triple or that home run. And it's just, it's very difficult to do. The second one is anchoring. And this is relying too heavily on the first piece of information we receive. And so that's an important cognitive bias as well. Confirmation bias, and this is one I see a lot, is seeking out information that confirms our existing beliefs. And then loss aversion, and this is very common, it's feeling the pain of losses more acutely than the pleasure of the gains that we get. And so these biases result in suboptimal decisions, and they hurt our long-term returns and our success. Emotional factors. So fear often can cause investors to get out of investments or maybe avoid market bottoms by selling out of their portfolio or their investment plan. Greed can drive investors to chase hot investments after big runs. We've seen some really big, some very large U.S. companies have performed very well in the last 12 months. And we can tend to notice that and jump on that train, hoping for big returns. And then regret. Regret leads to losing investments or maybe selling winners too soon. And, obviously uncontrolled emotions can lead to buying high and selling low. And to be disciplined, you want to be able to rebalance when necessary, but not chase the market or chase investments by buying high and selling low. So let's look at some consequences of poor behavior. So excessive trading, or and this could be getting out of your investment plan at a certain point and then planning to try to get back in the market later, or just trading randomly. But excessive trading can lead to high fees and taxes. Concentrated portfolios, undiversified portfolios are going to give you a lot higher risk. And then deviating from long-term plans and missing out on compound growth. Failing to capitalize on market returns over full cycles, not having that time in the market to capture the returns that are there for the taking. And all this leads to really failing to achieve our long-term financial goals. So how can we behave better? What are some things we can do to give us the best chance of a positive experience over our financial life? All the way from, again, from that very first time we're starting to save and build wealth until the very end. And we can certainly practice patience and discipline and sticking with our well-crafted investment plan. We can diversify. So we want to be globally diversified, spreading risk across different asset classes, different sectors, different regions, different countries. One of the biggest ones I think that are important, and Deanne and I talked about this last week, is dollar cost averaging or systematic investing. Invest on a regular schedule. And it's so much better that way. It helps us stay grounded. It's out of sight, out of mind. It's automatic. It's really on autopilot. And then rebalancing again, just periodically adjusting our asset allocations to maintain that appropriate risk level that's been set for us. And just some strategies around being more successful financially. Your investment plan should be dictated by your financial goals. And I will say this: beating the market should not be a financial goal. It's financial goals are personal to you. Achieving those goals could in fact be beating the market. Sometimes it might not be necessary. And so again, you want to have your investment plan focused just around your financial goals. And time in the market, I said this earlier, it's time invested, time in the market, not trying to time the market. And then have an investment policy statement that governs your decisions. Things like rebalancing, risk tolerance, time frame. Having that asset allocation approach, or that strategic approach to asset allocation, and then aligning that plan with your goals and your risk level is very important. And again, dollar cost averaging, rebalancing systematically, and having a plan and having perspective. And I've said this before. I did a presentation maybe a year or two ago, and the title of the presentation was Get Perspective. And I think if we can help people get perspective on behavior, having good behavior, how markets work, educating people on the way markets work, what to expect, they tend to stay grounded. They tend to stay invested. They're more than likely not anxious, not worried. And so planning and perspective is very important. So when I said time in the market, this is a great slide that I like to show. If you look at the S&P 500 index from 1990 through 2022, and you invested $1,000 and you stayed invested that whole time, your $1,000 grows to just over $21,000. And then working towards the right, you can see the reduction in wealth or value if you missed the single best day, or the 5 best days, or the 15 best days. And the point of this, out to 25 of the 25 best single days, the point of this slide is just missing a few days can drastically impact your results. So time in the market, not timing the market. So I wanted to run just a couple of different slide. I wanted to run some numbers on the S&P 500 looking at different time periods. And this goes back to having perspective and knowing what to expect. So this is the S&P 500 from 1995 through 1999. And it's a very impressive chart. And these next few slides are based on $1 million starting investment. So clearly, this was a very good period. So your 1 million grows to 3.5 million. Now, if we take that same million and we look at January 1st of 2000 and we go through 2004, we're at 886,000. And I think one of the things to take away from this is if you were starting out investing, or if you retired in 2000, or if you inherited money in 2000 and you invested it in a very appropriate way, it could even be a more diversified portfolio. S&P 500 is one index. It's not a diversified portfolio. But just as an example, it might be 3 to 5 to 7 years before you see results. And the point of that is you have to have that multi-decade view. It's not a sprint. It's a journey. And so you've got to be able to look at it in 30-year clips. And so if you started investing in 2000, you're disappointed 5 years in, disenchanted, disappointed, and you're more likely to shift or change or throw in the towel unless you know up front this could happen. This could happen. And it's not that there's something wrong with the investments. This is how the market works. Let's look at 2005 through 2009. So you came out even, broke even, 1 million to just over 1 million. So again, different periods, different short-term periods we're looking at. This is the entire decade of the 2000s. So 2000 through 2009. So here's an example of a piece of my portfolio, which might be in this index, a small percentage, has underperformed for 10 years. Again, that could lead to anxiety, could lead to worry, stress, and that's where we have to help people. We advisors at Elevate have to help people get perspective, stay grounded, and reiterate and re-educate why we're doing what we're doing. Let's look at the longer term picture. So let's go back to 1995. And I ran this through March 31st of 2024. So 1 million grows to almost 20 million in this index. So having that long-term view, having that time in the market without missing any periods, results in more wealth created, which results in higher incomes, more success, reaching your financial goals, all those things. And we can run these same numbers using different asset classes, different indexes. The story's the same. So since 1980, we've had 10 bear markets, which is a decline of 20% or more that are at least 2 months long. 6 recessions, which are declines in economic conditions for 2 or more successive quarters. So there's been lots to worry about along the way and lots of challenges. And this is a look at just a broad-based world index, the green line from 1970 through 2023. And you can see that there are all the world events, the market events along the way that would have offered challenges. And by navigating through that and staying the course, we can see that $1 grows to almost $100. And that green line, while it's not straight, it's upwardly moving with temporary declines. Another way to really get perspective and have have the right mindset is to understand that markets can be volatile. Declines are normal, volatility is normal. And if we look at this slide, we've got a US market performance from 1979 through 2023, and we've got gains and declines for every calendar year. So the blue bar is the largest gain during the year. The gray bar is the largest decline during the year or intra-year. And then the dot, the circle, is the calendar year return that you get. And the takeaway here is that almost every year, not every year, but almost, most of the time, the market during the year will experience a decline. And sometimes it can be significant. I think the average is around 14 to 15%. So knowing that going into our retirement, wealth building, transition, distribution phase journey can help us stay the course. This is just a look at the US market and just ranking negative years versus positive years from 1926 through 2023. So this is the smallest of small companies to the largest as a group. And as we can see that 74% of the time we experience a positive return, and 26% of the time we experience a negative return. So I like those odds. This is actually the first quarter of 2024, again, looking at not just the market or just an index, but looking at country performance and how random it can be. And that's why we have to be diversified. And so the first quarter of 2024, we've got countries ranked in order of performance from the Netherlands all the way to Egypt. And you can see the returns on the left. This chart will look different every single quarter, every single year, every decade. And that plays right along with this next slide, which is we never know where the returns will come from, but we have to be diversified to capture those returns. And so this goes back to prediction, or if we're trying to predict which investment or which country will perform the best, it's completely random. Nobody knows. People can forecast this, but no one knows. So having exposure to all of these areas is really the best way to get to that point where you've had a successful experience and you've created enough wealth to meet your financial goals. So it is an election year. So I wanted to plug in a slide from 1926 through 2023. And it's the S&P 500 again that I want to use as this example. And it's $1 invested through different administrations. And again, the takeaway, just like a prior slide through all those world events and market events, the takeaway is the market is permanently moving upward over time with these temporary declines. And it's a coin flip as to whether it's a Republican or a Democratic president, as far as how the performance ends up being. Both have had shares of declines, both have had shares of gains. But I think this gives us some ideas that, hey, regardless, the market is upwardly moving. There are some couple of quotes I want to share from Benjamin Graham, who, if no one knows, Benjamin Graham went to Columbia University, worked on Wall Street, went back to Columbia University to teach an investing class in their school of business. His student was Warren Buffett. So Ben Graham was sort of like Warren Buffett's hero, if you will. And he had a lot of great quotes that tie into behavior and psychology. And so I just want to just read a few of these. The investor's chief problem and even his worst enemy is likely to be himself. Successful investing is about managing risk, not avoiding it. Thousands of people have tried, and the evidence is clear. The more you trade, the less you keep. Individuals who cannot master their emotions are ill-suited to profit from the investment process. By developing your discipline and courage, you can refuse to let other people's mood swings govern your financial destiny. In the end, how your investments behave is much less important than how you behave. The intelligent investor is likely to need considerable willpower to keep from following the crowd. And how do we create or cultivate a positive mindset? Focus on patience and discipline to stick with a well-designed plan. Emotional intelligence to make rational, not impulsive decisions. Keep a long-term perspective focused on goals, not the short-term noise. And continuous learning and adaptability to evolving markets. To conclude and just reiterate some things, investor psychology plays a huge role in our outcomes, in our investment outcomes. It's much more important than people realize. And that's why I enjoyed putting together this presentation for today. Recognizing and overcoming the cognitive biases we talked about and those emotional factors we talked about. Again, cultivating a positive, disciplined mindset for the long run, and embracing evidence-based strategies and seeking guidance when needed. Controlling natural human tendencies through awareness, perspective, and discipline is essential for us to make smart choices, smart decisions, and achieve our long-term goals. And as we like to say often, focus on what you can control and control it. And some of the ways you can do that is partner with a skilled wealth advisor who can give you objective, experienced behavioral guidance. This will greatly increase your chances of long-term success. Have an investment plan, create that investment plan with your advisor that's tailored for you and your needs and risk tolerance. Have a diversified, structured portfolio. Diversify globally. Manage expenses, turnover, and taxes. Maintain a long-term view and perspective. And stay disciplined through different economic and market cycles along the way. So that concludes the presentation. I hope you enjoyed it. There's a lot more we could talk about, and I'm happy to answer any questions, whether now or if you have some questions you want to ask later. You can email me, call me, and I can elaborate on some of the slides that you've seen, things like that. So, but I appreciate your time.
Thank you so much, Clarke. That was great. We don't have any questions yet, so if anybody has some, just pop them in that Q&A box. But I wanted to ask you, out of all those different investor behaviors you see, which of those biases is the most common, would you say?
Loss aversion is probably in the top. It's probably one of the top two, I would say. There's several that could compete for that, but you see it. You do see it a lot, and we meet people for the first time, and maybe some of those biases are present. And then as we work with them over the years, they just disappear. And that's what's great about doing having that approach to behavioral coaching.
Very cool. So it sounds like the number one takeaway is just stay disciplined. Would you
It,
agree?
it is, and it doesn't happen overnight. It's a work in progress and it's easy for us to say stay disciplined, but when it's somebody's livelihood, an individual or a family, and so it takes practice, a lot of practice, and so creating discipline, having the right temperament, patience, and that's why we do so much education around how markets work, because the more you can understand it, the more comfortable you can be when we encounter those things. So, yeah.
Well, thank you. And I wanted to just show everybody also our YouTube channel. So if you go to youtube.com and look for Elevate Wealth Advisory in Athens, Georgia, you can see all the different videos that we put out. We do, of course, a webinar like this once a month, but we also do a weekly YouTube video. And Clarke has spent the entire month of April talking about this subject, answering questions from some of our clients or other people that have asked him things, and how they relate to behavioral finance. So be sure to check this out. And then if there's any questions you think would be interesting for us to answer, please feel free to send those my way at marketing@elevate-wealth.com. We also have Rob Fazekas, one of our other advisors, has written a blog post about behavioral finance. So be sure to check that out. That's coming out tomorrow. All right. Well, that is all for today. We really appreciate you, Clarke. Thank you so much, as always, for stepping up and helping lead these educational seminars. They're just always so interesting, and you're very wise. So we really appreciate all that you do.
Happy to. Thank you.